Well, as we've been talking about, Treasury yields have soared on those rising concerns over Obama's tax plan and the huge U.S. budget deficit. I want to bring in Marc Faber. He's the editor and publisher of the Gloom, Boom, and Doom report. He correctly predicted the financial crisis back in 2007. Among other predictions, he's been correct on. Marc joins us over the phone from Chiang Mai, Thailand. Always good to have your thoughts on our program, Marc. And where do you think all of this is headed?
Well, basically, my view has been for quite some time that in December 2008, when the 10-year Treasury note yield went down to 2.08%, that this was kind of a generational low, that this was a secular low, and that from here onwards yields will go up, either because of inflation or a better economy, or because of the huge deficits, or a combination thereof.
So now what we are seeing is what, a concern about the deficit?
I think increasingly investors begin to realize that between the Republicans and the Democrats don't want to increase taxation and the Democrats don't want to cut spending. And so the deficit, in my opinion, will stay above $1 trillion for as far as the eye can see.
Okay, but Marc, but as I say, where is this headed? Because you've got borrowing costs now going higher in the U.S.
Yeah, sure.
But it's higher in Japan, it's higher in Germany, it's going to be higher in the UK.
Yes, sure.
Where is it headed?
But the Treasury yield, say the 10 years at 3.25%, where it is today, is still extremely low compared to the underlying cost of living increases that are probably in the U.S. running at plus 5% to plus 8% per annum. I mean, don't believe from the BLS published CPI figures.
So then does that mean, Marc, then we should be okay, then this economy is not going to double dip?
I don't think it will double dip for now, and we live in a global economy today. And you have parts of the global economy that are relatively weak, like the U.S. and Europe, although from the lows they have recovered somewhat. But then you have other parts of the world that are still very strong, the emerging economies, in particular China and India. Now, the big question is obviously what will happen to that part of the global economy, because that has been driving overall economic growth in the world. And I think the Chinese economy is decelerating, and I think that next year there could be some significant disappointments.
So then, but you have a lot of your investments in Asia, Marc, then what are you doing?
Well, I've written that I've been lightening up. I still have positions because I don't see a lot of alternatives. I own gold and silver, and I own real estate, and I own equities. But I'm not attracted to buy U.S. Treasuries at this stage, although I have to say, maybe in the very short run, say the next 10 days to 2 weeks, Treasuries could rebound in kind of a technical rebound. But that isn't the long-term view. I think in the long run, interest rates will go up and they'll be eventually significantly higher. In my view, the 10-year Treasury note yield should be around 5%.
Should be about 5%. The 10-year should be 5%. But people are saying that if it goes above 4%, we're going to be in a double dip.
Well, I'm not sure that if we go to 4%, we'll be at a double dip, because it depends on the inflation rate. And if inflation is running, say, around 5, 6, 7%, and you have 10 years yield at 4%, it's still very cheap to borrow money. And the corporate sector has been borrowing a lot of money.
So then, Marc, if you would buy into Treasuries on a rebound, would you also buy into equities at all then, U.S. equities?
Well, I mean, U.S. equities come up reasonably well compared to emerging market equities at the present time. This is not a long-term call, but tactically, right now, I think the U.S. market may actually outperform emerging markets. The market I like actually best is the Japanese stock market.
The Japanese market. Well, that's an idea, Marc. We'll have to leave it there. Good to talk with you. Marc Faber there from Thailand. Sure.